Hi, welcome back holders. If you haven't catch part 1 of the earnings breakdown, do remember to watch it first. I'll leave the link in the description as well. So in part 1 of the video, I talked a lot more about the maturity of the company and the core commerce section of Alibaba, which is literally the entire cash generating portion of this specific business. So I also expounded a little bit more about what I think the strategy and vision would be for China commerce specifically. So in this video, we will talk more about the numbers behind the other 4 pillars, which are international commerce, local consumer services, Cainiao, and of course our all-time favorite, which is AliCloud. So I will leave international commerce and AliCloud to the later part of this video because they are essentially more vital for our projections. You know what else is vital? Smashing the like button, of course. So please help me smash it. First, let's look into the local consumer services arm. So on a year-on-year basis, revenue actually grew by 27%, but top-line EBITDA magnified its loss by 15%. So personally, I don't place much emphasis on this segment of the business. It seems like most ride-hailing and consumer platform delivery models have companies like Meituan, Grab, Uber, DoorDash. They seem to have a very hard time in trying to turn profitable. I'm not hopeful that Alibaba is able to outcompete Meituan and monopolize the market at least in the short to medium term. So one of the possible explanations for this expansion is really to just provide an additional value-added services to its existing customer base. And they can then try to upsell or even cross-sell other offerings Alibaba has to make their family of apps, if you see what I did there, more entrenched in their everyday lives. So the bonus cake is that they get to harvest more data from the specific users across the different platforms and apps to curate a much more accurate customer profile based on their spending patterns and, more importantly, the background analytics. Next, looking at Cainiao. Cainiao is probably the beacon of light for this entire earnings. They grew their top-line revenue by 15% year-on-year, and it does seem like they're achieving some sort of scale, which essentially drove their EBITDA margin up, despite it just being a small amount. So they cited that the increase was due to the penetration of cross-border and international commerce retail businesses, as well as the increase in revenue from some of the value-added services provided to their different merchants. So just to remind everyone on the Iron Triangle strategy that sets the foundation of this said business. A cutting-edge e-commerce platform, secure and quick financing and reliable solution, and a respectable and efficient logistic prowess. So as mentioned in the first video, it's in the DNA of this specific company to favor asset-light, low-maintenance business model. However, there has been an increasing emphasis on establishing their own network of logistical capabilities. While still keeping the same ideology, Cainiao Network was born. So this specific vertical will be an important prerequisite, especially moving forward when they require tighter control of the entire chain to tailor the end-to-end e-commerce experience. Now, going into the exciting portions of this discussion. Alibaba's international commerce section did okay on a relative basis, where they grew 18% year-on-year, but the adjusted EBITDA doubled. If you were to just look at the top-line growth, Lazada grew by 52% and Trendyol grew by 49%, which are both extremely respectable rates. However, they were also the leading cause that led to the huge cash burn as cited by management due to the increase in marketing and promotional spending for user acquisition and user engagement. So I think a point to note here is, especially for investors that have huge vested interests, especially in this e-commerce industry, I think Alibaba had finally listened to my prayers for putting more emphasis in the C region, which is Southeast Asia. Previously, I think there were definitely many concerns about aggressive expansion and taking on competition like Shopee in this region. At present though, it seems like the company has no other choice but to expand outward to capture more growth externally and to seek for more opportunities and optionalities. So I think the showdown in Southeast Asia will be a bloodbath. But thankfully, Alibaba's core commerce business is a cash-generating machine, and I look forward to the war between Lazada and Shopee that was so much long due. Growth from international commerce wholesale remains strong as China keeps its title as the manufacturing powerhouse of the world. And with or without a pandemic, with or without a war, with or without CCP, people will keep on consuming. So on the last vertical, which I think most investors pay close attention to, it seems like Ali Cloud will be the quote-unquote metaverse movement for Alibaba, and it will be the new curve for the company to venture into. Revenue increased by 20% year on year, which is not too bad, but it wasn't spectacular as well. I think many investors had much higher hopes for this vertical. Margins were also improving because they realized economies of scale, and it seems like they will definitely close profitable for this financial year. That said though, quarter-on-quarter revenue actually stagnated, and it definitely caused some commotions online. So as Ali Cloud is the dominant player, investors soon realized that hey, the total addressable market for Chinese cloud providers specifically pales in comparison to the likes of Microsoft, Amazon, and even Google Cloud Services. So we know US-based cloud providers can grow at a 50 or even 60% clip at the start due to the mass adoption and the huge commerce requirement. But Chinese companies find it challenging, and rightfully so. That said though, there are still untapped potential, both in the Chinese markets and countries in the eastern side of the globe who are more comfortable working with Chinese companies, although arguably they might be less wealthy on a relative term. Furthermore, they opened 2 data centers in Korea and in Thailand, further concretizing their resolve and ambition in this entire Southeast Asia region. Personally, I don't think it's game over for them, and doubt that Microsoft and Amazon will continue on with this duopoly. I believe that Ali Cloud will have their own proposition and positioning in this entire competitive landscape. Side note though, China's cloud market outlook looks to 5x from 2020 to 2025 to 1 trillion renminbi total addressable market, and currently Alibaba holds around 38% market share, and the next closest would be Huawei at around 17%. So let's just assume that Ali Cloud essentially executes poorly and their market share drops to 30%. That's 300 billion renminbi of market to tap into in 2025, and that translates to around $48 billion USD. Wait, remind me, what is Alibaba's market cap again? Oh yeah, it's less than 300 billion. Spectacular. I don't know what multiple are we tagging this company with anymore. So to add on some miscellaneous points, number 1, Alibaba's sales and marketing rose by 50% year on year, essentially representing greater margin compression while trying to fend off competitors, reinforcing the fact that hey, Alibaba's management team has to continue working hard and bring their A game, because they are not as entrenched as companies like Apple and Google, where they can just sit back, raise prices with little to no repercussions. Number 2, the share repurchase program was essentially non-existent, where they purchased back 8.7 billion renminbi worth of shares, but issued 8.6 billion renminbi worth of share-based compensation. Number 3, they are currently sitting on 59.4 billion USD worth of net cash position, which is a relatively huge sum of money for quite some time now. In my live stream last week, I understand that many investors were frustrated with this huge cash drag, and many of them were encouraging Alibaba's management team to essentially return all this cash to shareholders via buybacks or even start declaring dividends. Currently, Alibaba also pledged to buy back another $7.5 billion worth of shares by December this year, but at such depressed pricing, I think the executive team should not waste the opportunity to consolidate and to concentrate shareholders' ownership. That said, I understand that keeping a huge cash position allows the company to pivot and to acquire easily to help strengthen their value proposition, such as the integration of a hybrid commerce experience with the help of Sanat, for example. That said, there might be another consideration where how this entire crackdown event is going to affect the share price, and maybe the executive or management team is still holding back before ensuring that the entire change in macro environment before going in aggressively and start consolidating and buying back more share. So I think in conclusion, there are a fair share of both good and bad news revolving around the company in this earnings report. And for people that continue hoping for a great rebound, will continue staying disappointed. There's a reason why the market sold down this particular stock and cut its value by 2/3 from its all-time high. That said though, the more despair investors are, the more I will continue accumulating as long as my assessments remain consistent. Clearly, cloud and international commerce are the 2 frontiers that Alibaba wishes to pursue, while at the same time guarding their network back at home. Given that investors are attracted to high growth rates and quote-unquote perceived lower risk elsewhere, I can assure you that we will not get any forms of acknowledgement or assurance from the Chinese government on the crackdown sentiments anytime soon. and the entire delisting thing will come on out again at the later part of this year, in case you have forgotten. So all things considered, slowing macro conditions back at home, unprecedented regulatory pressures, extraordinary changes to policy stances, competition from all fronts, I'm still putting my money where my mouth is at, essentially sitting tight with the management team to weather this out together. So at first glance, it seems like Alibaba is a goner. Everything down, most of it red. But before I end this video, I'll be flashing a series of screenshots of another company's reported earnings in the same quarter. And you get bonus brownie points for guessing it right in the comment section down below. Chinese companies are pathetic. Seems about right. I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!